Okay, let's discuss candlesticks. One of the most important technical concepts for us to be profitable with the system that we use. So, a little bit of history about the candlesticks. So, it's reported that the candlestick pattern itself was created by a man named Monehisa Home. He was considered a supreme trader, and in his day, his discovery made him more than $10 billion in today's time. This way of visualizing data is brilliant because what happens with the candlestick is that it captures two movements: the movement of price as price rises and falls, and the movement of time as time goes by. If you look at the data here, the candlestick, it has 4 data points when it comes to price. And then also within that candlestick, there's 4 data points when it comes to time. So there's an opening price, which is here. This is a bullish candle. This is a candle that goes up. We'll talk about the anatomy of a candle in a minute. But here, let's say we are at a certain point in time and price starts here and it goes down to this price as time goes on. And then it rises up to this price as time goes on. And then it closes here, okay? So all of this is captured within this candlestick picture. And as you become more used to seeing candles, if you're a beginner, it takes some time. If you're intermediate or advanced trader, then you're well aware of candle patterns. But this is brilliant because the candlestick is giving you the story of time. It's telling you the struggle between the buyers and the sellers at a given particular time. So we will use candles to understand at a given moment in time where price is likely to go. And we will use candlesticks and the stories that they tell in order for us to time our entry and get high risk to reward setups. It will all be based on the candle as our final confirmation for our trades. So we talked about market structure. We talked about zones and levels, support and resistance. Now the candles are going to help us with our entry, help us get precise entries that will give us great risk to reward. So let's look at the bearish candle. The bearish candle is the candle that goes down. So price starts here. This is the opening price here. And it went up, okay? That's the highest price it ever reached here. Then it went all the way down here. This is the lowest price it ever reached. And then it comes back up, and this is the closing price. So what this tells us is that there was a struggle of buyers because the price was going up. But those buyers were overcome by sellers or by supply, sell pressure. So price goes all the way down, but there was enough buying pressure, enough demand for price to rise up a little bit more. So price didn't continue down. But we have a solid candle. This body here shows that there was a lot of selling. See this curve? There's a lot of selling going on. Okay. So this is a brilliant picture, this candlestick, because it has so much data. You can quickly see what was happening in the market by looking at one candle. If we didn't have candles, we would have to look at numbers. We'd have to look at the opening price, the high, the low, and the closing price in numbers, which will take longer. This is more efficient. This is more scalable because we can look at an entire chart of candles and see what was happening at different time points. So now let's talk about the anatomy of the candle. Let's align on some names. So this is representing the bullish candle. The bullish candle represents the candle that is rising in price. The candle that was that demonstrates that there was more buying power. The one on the left, on the right here, represents the selling candle or the bearish candle. We'll always call this one the bearish candle, where there was more sell pressure in the market at this time. The opening price is higher than the closing price. Okay, so this part is called the real body. This is the body of the candle. This is the real body. This is the distance between the closing price and the opening price. Okay, so price opened up here, it went down here. Okay, went below the opening, came back up, went to the closing price, went past that to the highest price, and came back down and closed here. So these are called wicks of the candle or shadows. The lower shadow is demonstrating the lowest price, the difference between the opening price and the lowest price. Okay, so this is a shadow just to let you know that price pushed down, but buyers came back in and took control. So this is just letting you know though that it went down and that price actually went down. There was some sell pressure, but buyers took over and took the market up. So price went up here to the highest point, came back down. What this shadow or this wick is telling us is that there were buying pressure on the top. There was buying pressure on the top, but sellers pushed it down, or the sell pressure came in, pushed it down. So price landed here. So this gives us a story of what happened, 4 data points, okay, that we can work from to understand what was happening in the market. And in the bearish candle, price opens up here, it went up, came back down. So this wick is here, or this shadow, the upper shadow is there. Price is pushed down and came to this low point, but couldn't go further. Price pushed up and it closed here. The majority of the move was bearish here. Okay, so depending on how you set up your charts. When you're looking at your charts, when we get to that point, some people use green for the bullish candle. Some people use red for the bearish candle. So if the candle here is red, let's say we pretend we use red. If the body is red here, that means that was all bearish pressure, a lot of bearish pressure. If we use green and the body is green, full green here, then that means there was a lot of bullish pressure. So the candlesticks are our friend. We are going to use them to understand what is happening at a given point, and we will enter because the candle will give us a good idea of where the price is likely to go. So let's look at the body sizes. The candlesticks have different body sizes. Sometimes they may be very short, meaning that there wasn't a lot of movement in the market. Sometimes they are long, meaning that there was a lot of movement in the market. So you can have small bullish candles, small bearish candles. You have large, long bullish candles, large, long bearish candles. So let's go a little bit further. Let's talk about the shadows. So the shadow can be very long here on the top, or it can be very long on the bottom. So we'll talk about what this means, what this visual means here in just a minute. So there's one candle that is known for indecision, showing us that there wasn't really anyone in control. The buyers weren't in control. The sellers weren't in control. And this is called the doji. So all of the candles have been named. The different candlestick patterns, they have all been named. And it depends on what school or what traders you are learning from, you may have seen different names. So if you know some names and some of these names don't match what you know them by or the candle to go by, don't worry about it. It's still the same concept. And I'm using the names that come from the Candlestick Bible. So the doji, it's called the doji candle. It's where this is the opening price. The highest price is here. So price pushed up. Price came back through and went to the lowest price, pushed down, but came back all the way up to the same price it opened at, and it closed there. Meaning that the buyers couldn't take control here. The sellers couldn't take control. So here is a balance between supply and demand right here in this candle. So this is indecision. We don't know which way the market is going to go just by this one candle. We will learn how to trade the doji candles in the larger, broader context of market structure and zones. But inside of this candle here, if this was a 15-minute candle, 5-minute candle, 30-minute candle, 1-hour candle, within this given time, neither the bulls nor the bears were able to take control of the market. So that's the doji. Now, the doji itself, it serves as a reversal, a sign of reversal, okay? So we'll talk about when it serves as a sign of reversal a little bit later, but this is how you'll see it, okay? This one is a little bit, the point of indecision is a little bit higher here. Could be considered almost a dragonfly, but nevertheless, this is a doji, okay? Now, single candle patterns. So we will learn that you have single candle patterns, double candle or 2 candle patterns, triple candle patterns, or 3 candle patterns. So we're gonna learn the single candle patterns now. All right, now, one of the most important for our trading system, one of the most powerful candles, the one that I love to see in my zone, is the hammer or the pin bar. I like to just call it the pin bar. So the pin bar is the candle where it has a long shadow and a smaller body, okay? So for the bullish one, this is the bullish one. What this means is that the bears tried to push the market down, or the banks were pushing the market down to deceive the retail trader, to get them to enter into a sell at a particular zone. This is normally what happens when you see a bank trap. This is the candle that you normally see. So the price went down, 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 down to this point, which is the lowest price. And the bulls or the banks or the institutions push the market back up and trap those sellers, fake them out. This is normally the candle that we'll see at extreme zones, and we'll be trading from this candle. This is called the pin bar. Now, if you look here, market is going down, strong candles here, big bearish candles. So my candles, I use white and blue. So these candles are going down, and the pin bar is going down here. At one point, this candle looked like this one, big, giant, bearish elephant candle, but it was a fake out. So they faked the market, they pushed the price back up, and this is a sign that price is going the other direction, okay? So we'll use the pin bar. So this is called the inverted pin bar or the shooting star. I just call it the bearish pin bar. Long shadow on the upside, small body. This means that price was pushing up, could be a bank trap to the upside, and then price came back down and closed here, okay? This one here is also a reversal candle. So as price is pushing up, this is probably a major zone here. Price pushes up, the candle looked bullish at one point, looked like this one, and then it was a fake out, okay? Price goes back down, it closes here, and then goes in the opposite direction, okay? So long shadow to the top, small body, goes in the opposite direction. This is one of my favorite candles. Another candle that looks similar to the pin bar, but it's almost more powerful, is called the dragonfly doji. The dragonfly doji is the one where the body, it's almost no body at all, okay? So that means that price went down it's a long tail. Price went down, came back up to its opening price. So the opening price and the closing price are almost pretty much the same. This one is just like the bullish pin bar, in where it's a reversal candle. So price coming down here, price goes down, sellers start to sell here. On a breakout of this zone, price pushes back strong in the opposite direction. This is normally, when you see this one in the market, a lot of times if it's at a strong support or resistance zone, this is a fake out to the opposite direction. Okay, now the gravestone doji, this is the bearish version of the dragonfly doji. This one is the same. Closing price and opening price are the same. Price pushes up, it's a fake out, goes back down, and then it goes in the opposite direction in most cases. So this is the gravestone doji. Price went up bullish. This was a strong zone here. They took it up bullish. Bulls started entering into the market because they thought it was a break of this zone, faked them out. Price went the opposite direction. One of my favorite candles. Now, another single candle pattern is called the bullish marubozu. This one is powerful. Why? Because there are no wicks. What does that mean? There's no shadows. That means that price opened up here and there was no bearish pressure at all. No selling happened at all. Price opened here and just went straight bullish and closed here. No rejections or anything. That means that this is a strong, aggressive buyer pushing this market up. When you see this bullish Marbuzu, this means that that was straight buying going on. Demand was very high. Demand is higher than supply. There was not enough bearish pressure at all. This is normally a sign that there were aggressive buyers pushing the market up, looking for supply to purchase. Okay. And it's the same. The bearish Marbuzu is the same. Price opens up here and there's no shadow, meaning there was no buying happening. And there was just a lot of selling. So aggressive sellers here. This is a sign of aggressive selling. So when you see these, normally these are breaking through zones, or if there's a massive buy or massive sell, you'll see these kinds of candles. So you don't want to trade against these kinds of candles unless you have very good reason to do so and you know what you're doing. Now let's go to the double candle patterns. You may ask, aren't there other single candle patterns? Yes, but these are the most important for our system. So let's talk about the double candle patterns. So the double candle pattern, the first one that I love and that is very powerful, is called the bullish engulfing. The bullish engulfing consists of two candles. One smaller candle, a bearish candle. It's a smaller candle that is engulfed by a bullish candle. So the opening price is here, closing price is here. That means that the bears were in control over here, but this bullish candle engulfs this one to the red, displaying that the bulls have become more aggressive. Okay, so this is a sign, if it's in a strong zone, that the bulls have become more aggressive and they are about to rally the market. So if you look here, this is a reversal candle here. So price is going down heavy, big bear. This is a Marbuzu here, big bear candles coming. Now this candle comes here, Marbuzu candle, very little small wick. The sellers may be entering here if this is at a strong zone, but price reverses very quickly and a stronger momentum up is displayed in the bullish engulfing candle, meaning that the buyers are more aggressive now. And normally what happens is the sell, when you come to a strong zone, there may be demand here where there are some buy orders, and then those will stop the bearish movement. And then there are aggressive buyers start to enter into the market, pushing the market up. And that big bullish engulfing is a sign of the aggressive buyer. So once we see the bullish engulfing and it's in our zone, it's on a strong support, this is a sign for us to pull the trigger. Okay, so we want to get used to knowing and seeing our bullish engulfing candles. Next, on the flip side, is the bearish engulfing candle. So the bearish engulfing candle consists of two candles, a bullish candle, so it's a bullish smaller body candle, and then the bearish engulfing is the big bearish candle that engulfs the bullish one. So this is a sign that the bulls were in control, but now there are aggressive sellers here. Okay, there's aggressive selling here to say that if it's in the right zone, there's a possibility, a high possibility that price is going to reverse. So if you see here, we have bullish movement up, we have small candles, we have some indecision here, and then a big bearish engulfing here, engulfing this candle here. Now candles won't be perfect. So we have the drawing, but candles won't be perfect. Sometimes it's going to be shadows. So there's a shadow here, a wick here, but if the majority of the candle is massive, okay, it's big. So this is a sign of potential reversal. The next candle we'll talk about is the bullish harami. Some call this one the inside bar. So the inside bar, or bullish harami, I call it the inside bar. The inside bar consists of two candles. One that's considered the mother candle, which is a big bearish candle. It looks like the market is going down. And then there's a small bullish candle that appears, and normally you see this in certain zones. And what's happening here though is that there is some aggressive selling that sold into demand. So there are some demand orders, some buy orders that have absorbed the sell. And this candle here, this small candle, this bullish candle, is a sign that potentially the market is going to go in the opposite direction. So we want to look for this though. This particular pattern, we have to see this one in certain types of zones. And I'm going to explain which zones they are. We won't look for this in the middle of price moving. There are certain zones that we'll look for, and I'll show you some examples of those later on in the course. So the bearish harami is the same. We have, or the bearish inside bar, we have a big bullish move up that is most likely absorbed by some supply orders. So it stops the movement upward. And we have this bearish candle, the small bearish candle that appears, signaling that the market may go in the opposite direction. Again, this particular pattern, we have to see it in certain types of zones. So I'm going to explain what those zones are. Those would be the supply and demand zones that the bank supply, or big supply, big demand zones that we'll talk about in a later video. So one of my other favorites, the tweezer bottom. So this is when the bearish candle and the bullish candle are pretty much the same size, or very near. So what's happening here is the bears are pushing the market down, but right away you have the same amount of bullish strength. So it's equal force, almost like a doji, right? Where one pushes down, then the other pushes back up to say, no, the bulls are showing that they are aggressive enough to absorb this entire candle. So we'll normally see this during a reversal. So price is going down, bearish candle, and then bullish tweezers. Tweezer bottoms here, price reverses. So now tweezer tops, this is the one. So now let's talk about the tweezer tops. So like the bearish, or like the bullish tweezer bottoms, this one is a reversal candle. So you have a big bullish candle here that forms, that shows strong bullish strength. And then right away, the bears come into the market. The aggressive seller comes into the market and absorbs that entire candle to show that there's a potential reversal here. So price comes up, tweezer tops, boom, price melts. Okay, so that's one of my favorites. We'll use this one a lot in our system. Now let's talk about triple candle patterns. One of the most powerful 3 candle patterns is the morning star. The morning star is a bearish candle down, strong bearish candle, followed by a smaller candle. This can be a bullish or a bearish candle, smaller candle, and then a bullish candle. So what's happening here? There is aggressive selling happening, and then it's halted, and you have a small candle, okay? So this is normally a sign that they've hit some support. Demand orders have been able to absorb the sell and halt the sell. So after that, if a bullish candle forms, and again, if we're in the right zone, this means that there is some aggressive buying happening. So this is a reversal sign to us that we can buy if it's in the right zone. So price comes down here, bearish movement, bearish candle, small candle, big bullish engulfing candle. That's our morning star. Morning star, in the morning, the sun rises. So that's why this one is called the morning star. Okay, price is going to rise after it. You then have what is called the evening star for the bearish move. So you have big bullish engulfing candle that's stopped by some supply orders, small bearish candle, and then a big aggressive bearish candle to show that there are sellers here in the market. And this is a reversal. So here, price is moving up, bullish candle, smaller bullish candle, boom, big bearish candle. Evening star. Now price is most likely going to reverse here. So I love this one. This one is very powerful, very, very powerful. Now this one is just like the morning star, the bullish abandoned baby. I see this the same as the morning star, but I wanted to highlight this one because the gap. So when there's a gap like this from here to here, this is showing that there's very aggressive buying here. So think of it the same way as the morning star. So think of it the same way as the morning star. Now, the bearish abandoned baby, same. Think of this one as the evening star. But this gap in price here is a great sign that there is aggressive selling happening in the market here. This one is called the three bullish soldiers because there are three strong bullish candles. If this is in the right zone, this is a great sign that the market is going up. Likewise, you have the three bearish soldiers. If you see this one in the market, this is a great sign that price is likely to go down. The morning doji star, we think of it just like the morning star. So I've included these different variations because I like to show you that price is not perfect, right? So the morning doji star is just a morning star with a doji candle here. Indecision, right? So that means that price was bearish aggressively, and then there was a point of indecision here, meaning that there is some support. Whenever you have indecision, that means that price has hit some level of force, right? Level of opposition. And then you have a big bullish engulfing candle, and this candle is demonstrating that there is aggressive buying now, right? So there was selling, indecision, and then aggressive buying. So if this is in our zone, one of the strong zones that we'll talk about later, this is a great sign that price is reversing and going to buy. Likewise, the bearish star, so this is the evening doji star, same principle, same thing, but going in the opposite direction. So now let's talk about entries a little bit. We're going to get into entries a lot more later, but candlestick entries are very important. I use these all the time to get the best risk to reward. There are two places that I mainly enter from when it comes to candles. You can enter on the candle close. Let's say we have a big bullish engulfing candle here. When the candle closes in the zone, in our target zone, you can enter right away and put your stop loss below the candle. Or there's another way which offers an even better risk to reward, and that is 50% of the candle. Okay. So a lot of times, and you can back test this, you'll see that there's a 50% retrace. There's a 50% retrace or so, right? 40 to 60%. It's not going to be perfect every time, but there's a retest. Okay. You'll find a retest to about 50% of the candle for you to get a better R&R, and you can put your stop loss below the candle. You can give it a little bit more breathing room than what I have here in this picture, and we'll talk about this a lot more later. But the 50% entry will give you a greater risk to reward. So watch out for this. Please leave your comments and questions in the comment section. See you on the next video.